Welcome all. Ira Epstein, and here we are with your financial market wrap-up, your weekly edition for the first day of January 2024. Let me start off by wishing all a happy new year, a prosperous one, and I hope to do the job that you want to keep tuning into. You know, this year I was very political, and I probably should tune that back a little bit. And I did get complaints. I had some people that loved it, but I get what's there, and I will do a certain amount of tuning back, but not a lot. I think that a platform here on YouTube makes sense. In my subscriber videos, I don't do that. The paid subscriber video is purely for what you're paying for, my analysis, and I should stay away from that, and I did, if you really look. So I had a few people that wrote, and I said, okay, I'll think about it going into the new year, but no, I'm not going to completely pull back, because this is free to you. Most of you that watch this aren't subscribers, and therefore I'm going to use what I want as my form, or don't watch me, all right? It's really that simple. I'm going to do this regardless until I don't want to do it anymore. Those are my rules. Your rule is you want me to give you ideas, and that's exactly what I do. So remember what I try to do. Most evenings, about 5:30, 6 at night, I start recording videos Monday through Thursday that are the dailies. I will, on the weekend, do a weekly video. It can come out anywhere from Friday night to Sunday. And then I go back in and I begin my morning videos again for the subscribers. That is where the meat and potatoes are. If you think in this video is where I'm going to tell you buy here, sell there, put your stop here, here's your objective, I am not. What I do in these videos is I give you an idea what the pros are doing in the market, why I see what I'm seeing, and then I back it all up in my subscriber videos in the morning. So this is the feeder into it. So when we look back, how many of the big analysts got things right? Few. Go to Bloomberg this weekend. Go to Reuters. Start reading how people did and what the projections were. The first thing they'll tell you in all these is, boy, did the analysts get it wrong. This was going to be the year 2023 of the big recession. Did you see one? Throughout the year, my job was to say, I don't understand how you can have a deep recession or maybe even a recession as long as the labor market stays as strong as it did. Labor didn't stay up because of manufacturing. It stayed up because of the service sector. And now, through New Year's, that will come to an end. And now we start getting back to the next phase of whatever the new normal is. I say that because what are the big events now? We're in winter in many parts of the country. Down in Florida, other parts, California, where it's nice, it's always the same. But the service sector's here. The big event that just ended was last night, the big parties for New Year's, so on and so forth. We then look at interest rates. They were supposed to soar to 6%. You remember reading about that? It's a 10-year going there. The big bets are coming in. Billionaires are buying. They're doing so-and-so. Well, within the last 8 weeks of the year, the market went from over 5% to the low 3.8 in the 10-year. That didn't go. In the gold market, this was going to be the year where the dollar reigned supreme and was just going to run, which it did the first 6 months, and then it went down at the very end, which took the pressure off the gold market and let the gold rally. In fact, the inflation scenarios, the war scenarios from Gaza, what took off, kicked gold to an all-time high, and now it's settling back. So what is this year going to be? Well, it's going to unfold. I don't think you spend your time figuring out what it's going to be as much as where's the chart action, because at the end of the day, the chart knows everything. When you look at a price in the chart, please understand, everybody's opinion that has got money in the market is in that last price. So if you think there's something else going on, there isn't. It's all there, and that's what it's telling you. And when we look at how the year ended up, we were up for the month 5.31% this particular month. Now, if we go back the month before, let's see if I can get this to even do that for us. I don't know if it's going to let me. Let me come back here and see if it will. Yeah, there we go. So 5.31, 8.65. Let's just look at those 2 months. That's 13% right there before the decline. So you've gone up 13% without a correction in 8 weeks. I think that's fairly impressive, don't you? When we take a look at the weekly chart, and by the way, the weekly and monthly, the break close were identical at 41.22 and a quarter. Every single week, just take a look with me on this. Up 0.31, up 2.36, so that gives you what, a 2.7 roughly. And you add to that 3.7, 4.5, 4.6%. Add to that 4.7 or 8%. These are on weekly, 5.5. I'm just adding it together. And you keep going. And the numbers didn't stop. Can that keep going indefinitely? I'll be the first on record to tell you no. Okay? You're getting to the point where, like any rubber band, you've pulled it. How much forward have you pulled things? When is a correction going to come in? At any point. Do you play for it? No. Do you cut back your trading expecting it? Yes. Will there be window dressing this week? Yes, but that could also include profit taking. A lot of people adjust portfolios so they look a certain way at the end of the year, and then the market, as you get into the year, they go, well, now I've got my look. It's all published. December 31st is behind me. Now I get to do things I want to do. This market has been a running son of a gun. When you put the swing line on, every single week had a higher high, with none of these having a lower low week until you came back here, right here, in October. My two reports that I put out, one in September for you and one in the that I did, late October, calling the November rally and then early sideways action and the Santa Claus rally. Is the Santa Claus rally over in stocks? In theory, it ends Wednesday. It's the way I understand it from Yale Hirsch, the 5 days before Christmas. You go through the Christmas time frame, you get to the first 2 days, and it ends. That doesn't mean the market has to break. That means that particular cycle is over, and the market often did break. Otherwise, you'd go to January 4th, January 5th, whatever the day was. Yale didn't just pick it. He went back and did as most people do that use seasonals. They look back to see where the dates are and when the market over X period of time breaks. Can that be adjusted over the years? Of course it can. Do some services do it? Of course they do. But I'm just giving you where you're at. When we take a look at moving averages, the logical spot for support, if you had a big break in the market, is wherever the 18-week average ends up. Currently, it's at 44.82, and it's going to climb higher. Why? If you understand you're going to drop, if this is an 18-week average in red, you're going to lose some of the values here. You'll see. If I come back a little bit, what's the week before? 44.59, 44.36. So it's going up 20 some odd points a week. So you're probably going to be, as when we open tonight, Monday night, in the 4,500 level. I think that's very comfortable to say that's where it'll be. And you're at a Bollinger top. What do I teach about Bollinger Bands? If you haven't taken the Enhanced Bollinger Band course on our website at iraepstein.com under education, shame on you. 5% of the time will you stay over or under Bollinger Bands. There's a trade called a Gorilla Glue trade when you latch onto the bands. You've done it right here. It takes at least 3 weeks to do it. And typically, in order to keep going, you have to have an embedded reading. Embedded means that the red and the blue are going sideways over 80 for at least 3 weeks in a row, which you have here. Got it? You got your 3 weeks that just locked in. So when the red line gets back under 79, I predict you begin whatever correction you're at. And right now on the charts, the high probability would be it's going to go back when it corrects to make a run and attempt to get back to the 18-week moving average. Now, that's so far away from where you're at, you'd say, Ira, that can't happen. Well, it's 300 points. Why not? Why can't you get a bit of a correction? How much did you pull forward? When I look at the Dow, it's the same identical thing. So I know you're going to tell me it's going to keep running, and fine. I want to be with the guys that build in Vegas the casinos. They're building it not on people winning 95% of the time, that they're wrong 95% of the time, or some number. Do you disagree? Well, if the band says you're only going to stay over that 5% of the time. I've done studies which show it's very rare to be more than 5 weeks over it. Can you be more? Yes, every now and then during the year. Listen to my key word. Go back and count. Just count. And you come up with your own conclusion. I've already got mine. You have to prove me wrong. You will find an example here and there. You will not find it's anywhere near the norm. So you're getting stretched out. You'll move back to the right-hand side. It doesn't mean you have to break. But when this breaks down, that is when I'm looking for the correction to set in. Now, what was not as strong was the NASDAQ. It had a correction, but it too is now embedded. And the Russell has been the laggard all the way through, and suddenly it's trying to just hang in at that Bollinger Band, but it's been the laggard. It has, in essence, the strongest support areas because you're putting together all of a sudden the 200 in gray, the green, the 100, and the 18-week. All those moving averages coming together here. And when the 18 gets over all of them, it's probably a sign that the Russell has taken over some form of leadership, something in the market. It could be it doesn't weaken as much as the other markets. It could be it gets stronger. We'll see what the future holds, but that's what the pattern typically tells you. When I look at the 5-year note, here too, you've run to the upper Bollinger Band. Everything at the end of November and December was about rallies in these markets that at year end, you just reversed everything. If you don't agree with that, I don't know what you're looking at, but that's what's happened. Now, there's big resistance waiting for this market at the 100-week average if it gets there, and the same thing in the 10-year note. You're at the upper bands. I'll let the other guys want to buy those bands. In bed, I changed my opinion. I put out, because of the enhanced Bollinger Band course, a different strategy. It's not here on the weekly chart. In the dollar index, you have fallen apart into oversold territory if the market stretches itself. And that's what I'm hoping it does over time. The 200-week average is very, very attainable on a real stretch in the market. I put out 2 weeks ago Thursday, this past Thursday, a bearish report on the dollar index, my last one of 2023. It was very much on the money. I was predicting that you're probably going to get also, it's possible to get the 18-week to get under the 100 and throw out another bearish element. I think that's going to happen in the chart as well. In the euro, you're up at an area where you can get a correction. You're at the Bollinger Band and the first challenge of a 200-week moving average. You realize that's a 4-year moving average. There's 52 weeks in a year, so you're pretty darn close to 4 years. I'll let you buy it over that, thinking it's just going to keep going, or your enemy buy it over it. I would tell my traders, and I said, no, I think this is where the pros are going to take some money off the table. Doesn't mean we can't go through it later, but you probably need to consolidate some of these gains. That's my guess. Same thing in the Canadian. The dollar fell apart in the last 2 months of the year, and it accelerated down sharply in December, kicking all these markets into these highs. That's exactly what has taken place. In the yen, the marketplace has done what the Fed didn't do. Let me explain what happened. The Fed didn't raise interest rates the past couple of meetings. But the U.S. Treasury has gone in and taken over the role with all the money that we desperately need because America is spending more than it has. What's taken place is via that, in order to attract money, you had to pay relatively high yields or drive yields higher, one of the two. That was the same as the Fed adding another quarter point, and the end impact was interest rates in the U.S. stayed high, real high, and the economy has slowed down. You see that in the CPI numbers. Whether they're as fast on the drop of CPI, whether they'll stay that way, that's something we'll see that happens in 2024. But the combined effect of the Fed stopping